Are we ready to move on to the picking case bar range?
Yeah, certainly I think people understand the concept, but then comes the challenge of how to choose the range. What range should I use? And the methodology is very simple. Here at the top, we have a 15-minute chart. So, for example, if you were a trader and you normally would trade a 15-minute chart, you'd set up a 15-minute chart like you always do, and then you would apply the true range to the 15-minute chart. Now here, this is a 24-hour market, and we've got a very low true range overnight, and then the true range comes up during the day. So just on this chart, the true range is varying from about 1.85 to 2.65. And on most charting systems, the average true range is available. You just apply it to the chart. So I'm going to pick 2.25 as my target true range.
And why is that? Why 2.25?
Well, it's kind of in between the range, between 1.85 and 2.65.
Okay.
So I'm just trying to pick a representative true range for this chart. And so then I'm going to go into my case bar chart, and I'm going to set my target to 2.25. And whereas you can see at the top, the range varies around a bit from 1.85 to 2.65, on the bottom of the chart, the true range varies by very little. It's right around 2.25 for every bar.
Now, I didn't ask, am I able to get case bars? Is it something that's available in, say, like a TradeStation or Metastock or anything like that?
It's available presently on TradeStation, and it will be made available on Bloomberg Professional later on this year.
Okay. Is it something is an extra feature I have to pay for?
It's free on both systems.
Okay, got it.
Okay, and here's a similar chart. The next page shows a similar chart, the same instrument for a 45-minute chart. So it's a similar type of thing. We set up a 45-minute chart. We see that on average the true range is between about 3.68 and 4.10. So I'm going to pick 3.89 kind of as a representative size. And at the bottom, I'm going to set my target for the case bar at 3.89.
Yeah, I can see on the bottom, too, when we do input that even in a sideways market, you still get more of a feeling of being able to pick tops and bottoms a little bit easier, I guess.
That's right. It condenses, it spreads out high range bars, and it condenses small range bars.
So it eliminates a lot of noise, I think, in the market as well.
Tremendously. Let's look at one more chart on just comparing time versus case bars, and then we can look at some actual examples of charts, time versus case, with some indicators on the screen to see how it would make a difference in trading.
Okay.
The next chart is the E-mini, and the 60-minute chart. I've got a 60-minute chart on the bottom, and then I've got two different case bar lengths up on the screen. The top, you could just see by looking at it, the top chart has a few more bars than the middle chart, which means that the case bar range is slightly smaller. And what I've done here is because the E-mini tends to have a high range during the day and a lower range at night, the top chart is set to a representative true range for the 24-hour period, and the middle is set to a representative true range just for the day session. So anybody that's setting it up can kind of pick the maximum range if they just want a representative of the day session, or just an average range if they want a representative of the whole 24-hour period.
Does one give more signals than the other?
Well, the more bars you have, the more signals you're going to have.
Okay. Right.
So the next chart it shows the time chart at the top and case bars at the bottom. And with just a simple moving average system, double moving average system, crossover system, and the MACD. And so if you compare the signals from the top to the bottom, you can see you start out on the top with the time bar with the whipsaw, with the moving average whipsaw. And that whipsaw is absent on the bottom chart, the case bar chart. Then moving along in red, there's a momentum divergence signal, higher high in price, lower high in momentum, on the time chart, which gives a false exit system signal. And there is no signal at all on the case bar chart. Then moving forward, there's another momentum divergence which would trigger an exit. It confirms at 1089.75 on the time chart. It confirms at 1090 on the case bar chart. So confirms at a better price on the case bar chart. And then following that, there's another whipsaw. However, it's a 10-point whipsaw on the time chart and a 3.5-point whipsaw on the case chart. Also, to get back in, the time chart crosses over 2.75 points higher than the case bar crosses back. And then at the very end, both charts have a momentum divergence calling for an exit off the same high. So that's just a real simple example of the type of behavior that one sees on the time bars versus case bars.
All right, good. So it sounds like get you in at better prices and then keeps you out of bad trades with those false signals.
That's correct. Just a couple of snapshots to wrap up. Just a couple of snapshots with the Kase Statler system. We're only looking at entries here. But first of all, just looking at the charts, you can see that the chart on the right is just cleaner, smoother. The price action is just more regular. And if you look towards the right of the chart, of the time bar chart on the left, you can see there's a huge single bar move down, and that's broken up very nicely on the case bars. Now, our methodology is to take second signals in the direction of a trend. So we would look for a long signal with the low holding and then followed by another long signal. And if you look on the left, you can see that there's an L, a pullback, and a new L. And then the market declines. So on the minute chart, on the 60-minute chart, there's a false long signal, where on the case chart, there's only one L, so there's no false long signal. On the bottom of the move, after the down move is over, the opposite takes place, is that you have a down move that's then over, and then on the time bar, you only get one L, so you don't have a chance to get in, or let's say out of your short and into a long. Where on the right, there's on the case bars, there's two L's, so you're able to see that you have a second buy signal to reverse the trade, or get out of the short and reverse the trade, or just go long.
All right, so you found that the waiting for that second signal gives you a higher probability trades.
Yeah, I mean it's all based on Elliott wave theory. We have either 1, 2, 3, 4, 5 or ABC. So normally, if you're going to have a move, you'll have an ABC, so you can take the C, or a 1, 2, 3, 4, 5, you take 3. So that's the theory behind that.
All right, and you've got one more chart here for us: case bars versus time bars on CLN.
Yes, I have the last chart. It's case bars versus time bars. And before we look at the actual signals, let's take a look at the flag. You could see that on the case bar chart, you can see a flag. You could see a corrective flag. It's very clear. It's very clear about what's going on. And so a trader that knows anything about geometric patterns would be looking at that flag and saying, I'm not sure I want to trade this short, but certainly if I'm long, I think I want to stay long and wait for breakout to the upside. Or if I'm out of the market, I'm looking for a long signal to get back into the upside. Where on the left, that flag more or less disappears. It just becomes this very strange looking pattern. Also, so that's one feature, is that these patterns show much more clearly. And then the other thing is that if you look at the long signal coming up off the bottom, you only get one L. So on the 60-minute chart, we never get a pullback and a second L to get long. So we'd either have to jump in without confirmation or wait for the second L, which comes at the top of the move. Where on the case bars, you can see you get an L, get a nice pullback, and then a new L, and it goes up from there.
All right, and so again, these signals, these long and short signals, even though the Elliott wave is not counted there, or that's what the signal's based on, though, is the Elliott wave counts?
Well, it's based on the idea that very few market moves are comprised of one wave. Okay, so we don't count the waves, we just wait for a pullback and a new wave to start. So it's really based more on swings, pivot lows, pivot highs, and swings. So you have a pivot low, you have a long signal, you have pivot high, pivot low, and then a new long signal.
Well, we've just scratched the surface here, kind of covered a lot of ground. I guess
that's right.
People can go to your site to kind of find out more about Kase bars and how to use them?
People can go to our site, and there's a description of Kase bars in our manual for TradeStation, and those people that have Bloomberg can go to Kase Go within Bloomberg and take a look at Kase Go.
All right. Well, we'll link to Cynthia's site at Kaseco. It's KASECO.com. Cynthia, thanks very much for your time today. I appreciate you spending some time showing us the slides and showing us your Kase bars.
You're welcome.